Last week, I sat across from my laptop staring at a notification from my bank. It popped up right when I opened the app to check my balance. Just sitting there, cheerful, confident. Hi, Julia. Help us serve you better. Update your annual income so we can offer you the right products. Serve me better. I almost laughed out loud because I know exactly what that message is. It's not customer service, it's data collection dressed in a smile. And the moment I understood what banks actually do with your income information, I stopped filling out those forms entirely.
Here's what nobody tells you when you open a bank account or apply for a credit card. The income field on every application, every update request, every friendly pop-up, that number doesn't protect you. It gets used against you. Not in obvious ways, not in ways you'd notice immediately, but in quiet, algorithmic ways that shape your entire financial relationship with that institution, often for years.
Let me start with something that genuinely shocked me when I first learned it. Banks are not legally required to know your income in most situations. There's no regulation that says a credit card company must have your salary on file. There's no federal law mandating income updates on existing accounts. They ask because they want to, because wanting to know and needing to know are two very different things, and banks have spent decades making sure you never stop to ask which one applies. Think about what that means. Every single time you filled in that income box without thinking, you volunteered information that was never actually required. You handed them a weapon completely unprompted.
So what do they actually do with it? The answer has 3 layers, and each one is more uncomfortable than the last. The first layer is credit limits. Higher income gets you higher limits. That seems fair, right? Someone earning more can theoretically handle more credit. But here's the part banks never mention. Higher limits aren't a reward, they're a strategy. Banks have internal data showing that customers with higher credit limits carry higher balances. More limit means more spending. More spending means more interest. More interest means more profit. For the bank, not for you. That $25,000 limit they gave you after you updated your income, they're not celebrating your success, they're extending your leash.
The second layer is interest rates, and this is where it gets genuinely disturbing. You'd assume that higher income means lower rates. Better off customers are lower risk, so they should get better terms. Some of the time, that's true. But the algorithm doesn't just calculate your risk, it calculates your tolerance. There's a practice in banking called ability to pay pricing. The higher your stated income, the more the system assumes you can absorb, and the less likely it assumes you are to complain, compare, or switch. Someone earning $30,000 might fight hard over a 24% APR. Someone earning $200,000 might not even notice it. The algorithm knows this. It prices accordingly. Your high income doesn't automatically earn you better rates. Sometimes it earns you worse ones because the bank has correctly calculated that you won't bother pushing back. The third layer is marketing, and honestly, this one affects daily life the most. The moment your income gets updated, you get recategorized. High earners start seeing premium card offers with $500 annual fees, constant pitches for personal loans, investment products, private banking. Every login becomes an obstacle course of upsells calibrated to your income bracket. The bank knows that someone earning $180,000 is more likely to rationalize a luxury product. They also know that high income often signals financial complexity, multiple accounts, assets to manage, insurance to buy. More income data means more angles to sell from. Lower income customers aren't spared either. They just get targeted differently. Balance transfer traps, high interest personal loans, credit limit increases designed to enable overspending. The targeting changes, the exploitation doesn't.
Here's something most people never think about. That income number you entered years ago, it doesn't expire. It sits in your file. It influences decisions you never see. Credit limit reviews, rate adjustments, account closures during economic downturns. Banks run portfolio reviews constantly. During those reviews, income data is one of the primary inputs. A customer who reported strong income might have their rate quietly increased because ability to pay pricing says they can handle it. A customer who reported lower income might see preemptive credit limit cuts because the algorithm flags them as higher risk during uncertainty, regardless of their actual perfect payment record. Old income data with no updates is less useful to the algorithm. Stale data is less predictive. That's exactly why they ask for updates so persistently. Every time you refresh that number, you reset the clock. The algorithm wakes up, the targeting sharpens, the optimization begins again.
I have a friend, let's call her Mia, who learned this the hard way. She was a freelancer with variable income. Some months she earned $6,000, other months closer to $14,000. When she first applied for her credit card, she used her conservative months as the baseline. The bank approved her. Everything was quiet. 2 years later, the bank asked her to update her income to unlock a higher credit limit. She'd had a strong run of projects. She entered her current, higher number. Within 3 months, her phone wouldn't stop ringing. Personal loan offers, balance transfer promotions, premium card upgrades. Her mailbox looked like a financial product catalog. She'd been reclassified. The peaceful, low-maintenance banking relationship she'd had for 2 years? Gone. Replaced by an aggressive, relentless sales campaign. She stopped updating her income completely after that. Closed every pop-up without touching it. Within about 6 months, the calls died down. Her profile had gone stale, the algorithm lost interest. Her banking life returned to normal. Not because anything changed about her finances, but because the bank had less data to weaponize.
Now, I want to be absolutely clear about something before we go further. I am not telling you to lie. Providing false information on a credit application is fraud. It's illegal. It's genuinely wrong. Don't do it. What I'm talking about is something completely different. There's a significant distinction between lying and simply declining to volunteer. When a bank sends you a mid-relationship income update request, a pop-up, an email, a gentle in-app notification, you are under zero legal obligation to respond. Closing that pop-up isn't deception, it's privacy. It's you exercising the same basic right that the bank exercises over you every single day without your permission. Think about the information asymmetry here for a moment. Your bank knows your full transaction history, every purchase, every subscription, every late-night impulse buy. They know your payment patterns, your balance behavior, your debt levels. They run sophisticated algorithms on all of it constantly, and they use those insights to extract maximum value from you. You, meanwhile, know almost nothing about how you're being categorized. You don't see the algorithm. You don't see the profile. You don't know which decisions were influenced by the income number you entered 3 years ago. Refusing to update that income doesn't level the playing field, but it tilts it slightly less against you. Your behavioral data, how you pay, how you use credit, how long you've held accounts, that's harder to game than a number in a form. Banks have always had access to it. Let that do the talking. Let's get practical. Here's exactly when income disclosure makes sense and when it doesn't. For mortgage applications, disclose everything fully and accurately. This is federally required under qualified mortgage rules. You'll provide tax returns, pay stubs, employment verification. There's no wiggle room, and there shouldn't be. A mortgage without income verification is how 2008 happened. For auto loans, income disclosure is typically required. Standards vary by lender, but expect to provide documentation. Cooperate fully. For new credit card applications, income is requested but almost never verified. Credit card companies cannot access your tax returns without permission. They cannot see your pay stubs. They're relying entirely on what you tell them. Report accurately, but think carefully about what accurately means when you have variable income, side income, or multiple income streams. You don't need to report your highest possible number. You need to report a truthful one. For income update requests on existing accounts, you can ignore them entirely. Close the pop-up, delete the email, decline the call. There is no penalty. Your accounts will remain open. Your credit score will not be affected. The bank will ask again in a few months. You could ignore that, too. There's a psychological layer to all of this that deserves a moment. Banks have trained us to feel like non-compliance is risky. The forms look official. The requests feel authoritative. The implied message is, this is required. This is expected. Fill this in. Most people comply not because they've thought it through, but because the alternative feels vaguely dangerous. The first time you close one of those pop-ups without filling it in, you might feel a flicker of anxiety. Did I do something wrong? Will they close my account? Will my credit score drop? Nothing will happen. The bank wanted data. You chose not to provide it. That's a legal, legitimate, completely ordinary thing to do. The anxiety you feel? That's conditioning, not consequence.
Here's the deeper principle underneath all of this. Every institution that asks for your data is collecting it for their benefit, not yours. They might frame it as personalization, they might call it better service, they might say it helps them tailor offers to your needs. But the actual function of that data is to enable more precise extraction of value from your relationship with them. Data minimization isn't paranoia. It's a rational strategy for navigating relationships where you are, structurally, the less powerful party. Provide what's legally required. Decline what's optional. Understand the difference.
Banks are not villains. Credit cards and loans serve real important purposes. Access to credit enables economic participation in ways that genuinely matter. But banks are also profit-maximizing institutions that treat customer data as a resource to be harvested. Understanding that dynamic doesn't require cynicism, it requires clarity. They want your income data because it helps them make more money from you. Full stop. You can decide, consciously, intentionally, how much of that data you want to volunteer.
So the next time that pop-up appears, help us serve you better. Update your income. You'll know exactly what's happening. They don't want to serve you better. They want fresh data for algorithms that optimize their profit, not your financial well-being. Close it. Let your payment history speak for you. Let your account longevity speak for you. Let the actual behavior of a responsible, consistent customer be your profile. That's data they've always had. And unlike a number in a form, it's data that genuinely works in your favor. If this changed how you think about your relationship with banks, share it with someone who needs to hear it. Most people have no idea this is happening to them. Now you do.